Every company's financials tell a story. But if you really want to understand that story, you have to learn the language they're speaking, the language of cost. It's this kind of secret code that can take a simple bag of flour and turn it into either an asset or an expense. And believe me, that one decision can change a company's entire financial picture. So let's decode that language together. So let's just jump right in with a question. Say you run a bakery and you buy a big 50-pound bag of flour. What is it? Is it an asset your company now owns? Or is it an expense you've already paid for? Well, the surprising answer is it depends. And figuring out what it depends on is what this explainer is all about. So here's our roadmap. First, we're going to look at the three main flavors of accounting, which is all about understanding who the numbers are for. Then, we'll get into the two different faces of the word cost itself. After that, we'll see how accountants actually track and assign these costs, and then piece it all together to see how a product's cost is built from the ground up. And finally, we'll get to what might be the most important part. When does a cost actually hit the bottom line? Okay, first things first. How you talk about money in a business depends completely on who you're talking to. Are you putting together a report for investors who are outside the company? Or are you trying to help a manager inside the company make a big decision? The answer changes absolutely everything. So on one side, you've got financial accounting. This is for the outsiders. Think investors, banks, the government. It's totally focused on what's already happened, and it has to follow a super strict set of rules, basically a rule book called GAAP. But on the other side, you've got management accounting. This is for the insiders, the managers who are running the show. This is all about looking to the future, making decisions, planning ahead, and the rules are way more flexible. So what connects these two very different worlds? Well, that's where cost accounting comes in. You can think of it as the engine room. It's the system that provides all the detailed cost data that feeds both those backward-looking financial reports and those forward-looking management decisions. It's the essential bridge holding it all together. Okay, now let's zoom in on that word cost. It seems so simple, right? But in the world of accounting, it kind of has a split personality. It can mean a resource you have on hand, or it can mean the result of using that resource up. So for financial accounting, that's the one for outsiders, remember, a cost actually starts its life as an asset. Let's go back to that bag of flour. When you buy it, its cost represents a future benefit, the ability to bake bread later. So it just sits on your books as an asset, usually called inventory. It's only when you actually use the flour, sell the bread, that those benefits expire. And that's when the cost transforms into an expense that shows up on your income statement. But for management accounting, the whole perspective just flips. Inside the company, a cost is just a measurement. It's a way to answer questions. How much did we spend to develop that new app? What did it really take to service that big client? It's all about getting the right data to the right people so they can make better decisions for the future. So if costs are these kind of flexible ideas, how do accountants actually pin them down? How do they connect them to actual things in the real world? Well, it's all about connecting the dots. First up, you need a target. In accounting speak, this is called the cost object. It's literally anything you want to know the cost of. It could be a product, a whole department, or even a specific customer. Then you need a cost driver, and that's just the activity that, drives the cost. So for our bakery, the cake is the cost object, and a key cost driver would be the number of hours the baker spends making it. Now, some costs are super easy to connect. The flour, the sugar, the eggs that go into that one cake, you can measure it pretty much perfectly. That's a direct cost. But what about the factory's electricity bill? How much of that bill really belongs to that one specific cake? You can't really trace it easily, right? That's what we call an indirect cost. And this is where it really gets tricky. I mean, look at all these different indirect costs. You've got factory rent, the supervisor's salary, utilities, maintenance on the ovens, property taxes. How in the world are you supposed to fairly assign a little piece of each of these to every single cake, cookie, and loaf of bread that you make?
The solution is actually a pretty clever accounting tool called a cost pool. Instead of trying to assign every little indirect cost one by one, which would be a nightmare, you just group similar ones together. So you might have one pool for all the costs related to the building, another for all the machine costs. It's basically a big collection bucket, and it makes the whole messy process of allocation way, way easier to manage.
All right, theory time is over. Let's take all these concepts and actually apply them. We're going to walk through how a physical product gets built, and we'll see exactly how every single cost gets categorized as we go. So when you make pretty much anything, there are three basic building blocks of cost. First, you've got direct materials. That's the physical stuff you can literally see and trace, like the steel that goes into a car. Second, direct labor. These are the wages of the people physically putting the product together, like the welder on the assembly line. And third, you have, well, everything else. We call it manufacturing overhead. And this is our big bucket for all those indirect factory costs: rent, electricity, the supervisor's pay, you name it. Now, accountants often group these costs together in a couple of specific ways. If you add up the direct materials and the direct labor, you get what's called the prime cost. And that name makes sense, right? These are the primary, most direct and fundamental costs of actually creating the product. The other common grouping is what's known as conversion cost. This is your direct labor plus all that manufacturing overhead. And again, the name is perfect. These are all the costs you incur to convert the raw materials into a finished, sellable product. So we've defined all these costs, we've categorized them, but we're left with the most important question of all: when do these costs actually hit the income statement? When do they actually impact the company's profit? And this right here is the big divide. On one side, you have product costs. That's all those manufacturing costs we just talked about: materials, labor, and overhead. Their cost literally attaches to the product and sits on the balance sheet as an asset called inventory. It only becomes an expense when the product is actually sold. But on the other side, you've got period costs. Think of things like sales commissions or the salary for the marketing team. These aren't tied to making the product, so they get expensed immediately in the period they happen. And you can see how this difference has a huge impact on a company's reported profit from one month to the next. Okay, we have definitely covered a lot of ground. So let's do a quick knowledge check, just a little pop quiz to see if these concepts are sticking. First question. In cost terminology, what exactly makes up conversion costs? Take a look at the options. The correct answer here is C. Conversion costs are what it takes to convert those raw materials into a product. That's the direct labor plus all the factory overhead. All right, one more for you. What is the best way to describe or think about inventoriable costs? The answer is D. They are treated as assets before the products are sold. They live on the balance sheet, just waiting in inventory until a customer buys them. That's when they make the jump to becoming an expense. So if there's one thing to take away from all this, it's that classifying a cost, deciding if it's a product or a period cost, direct or indirect, is not just some boring academic exercise. Every one of those decisions has a direct, real-world impact on a company's financial statements. It literally changes the value of its assets, the timing of its expenses, and ultimately the profit it reports to the world. And that really leaves us with one final thought. Now that you know a little more of the language, the next time you look at a financial report, are you just going to see a page of confusing numbers? Or are you going to see the story behind them? The story of thousands of decisions about what to build, how to build it, and how to account for every single step along the way.